Right now, there is a number sitting inside your portfolio that almost nobody talks about, and once you see it, you can't unsee it. If you bought the S&P 500, you probably think you own 500 companies, 500 different bets, spread across the whole American economy. Safe, boring, diversified. Here's the truth. You don't own 500 companies. Not really. Today, more than 40 cents of every single dollar you put into the S&P 500 flows into just 10 stocks. That is the most top-heavy this index has been in recorded history. I have over $500,000 invested. The S&P 500 is part of that, but I do not trust it to do the one job most people think it's doing. And by the end of this video, you'll understand exactly why. I'm going to show you what you're actually buying when you buy the S&P. I'll show you the decade it quietly lost people money, and I'll show you the cheap, boring fix that takes about 5 minutes to set up. Quick note before we start. I'm not a financial advisor. Everything here is for educational purposes only. For your specific situation, talk to a qualified professional. And the strangest part of all this level of concentration has only happened one other time in modern history. It was right before a very famous bubble popped. I'll show you which one. How the 500 quietly became 7. So let's open the hood. When you buy the S&P 500, here is what actually happens to your money. The index is what's called market cap weighted. Plain English, the bigger the company, the bigger a slice of your money it gets. So the giants don't just get a vote, they get the whole megaphone. Look at the top of the index today. There's a group people call the Magnificent Seven: Nvidia, Apple, Microsoft, Amazon, Alphabet, which owns Google, Meta, which owns Facebook, and Tesla. 7 companies. Together, those 7 make up around 35% of the entire S&P 500. Think about that. You buy a fund of 500 companies and a third of your money lands on 7 of them. Here's the myth. It's 500 companies, so it must be diversified. Here's the truth. A handful of names drive almost everything, and the other few hundred are along for the ride. And this didn't happen overnight. 10 years ago, the top 10 companies were about 19% of the index. Today, they're a record 40.7%. The concentration didn't appear, it compounded, quietly, year after year. There's something else hiding in here. Most of these giants are tech companies. The technology sector alone is now around a third of the whole index. So when people say, I'm diversified, I own the S&P, what they often mean, without knowing it, is I made a giant bet on American tech. Now, a fair question, is concentration actually a problem, or is it just where the best companies naturally rose to the top? That's the right question, and the only honest way to answer it is to look at what happened the last time investors leaned this hard on a small group of winners. The decade everyone forgot. Let me take you back to the year 2000. Back then, everyone wanted the same thing you might want today, the hot American stocks, the S&P 500. Surveys from that era showed regular investors expecting returns of more than 20% a year, every year, forever. So what actually happened over the next 10 years? From 2000 through 2009, the S&P 500 returned roughly negative 0.9% per year. Negative for an entire decade. People call it the lost decade, and it's not a nickname, it's a warning. Put real numbers on it. If you put $100,000 into the S&P at the start of 2000, 10 years later you had less than you started with, and after inflation chewed through it, your spending power dropped by more than a third. A full decade of saving, investing, staying disciplined, and doing everything right, and you went backwards. Imagine starting your career in that decade doing the responsible thing every single month and having nothing to show for 10 years of it. That actually happened to a generation of investors. Now, here's the part that should change how you think. During that exact same decade, an investor who spread their money around the world did fine. Emerging markets returned almost 10% a year. International stocks were positive. Even an equal slice of those same 500 American companies beat the standard index. The people who got hurt weren't the ones who invested. They were the ones who bet everything on one country at one moment when that one bet was the most expensive and the most crowded. Quick question before I show you the fix. Drop a comment and tell me honestly, are you 100% S&P 500 right now, or do you hold anything outside the US? I read every single one, and I'm curious how many of you are all in. Now, here's where most videos would scream at you to dump the S&P and run. That is not what I'm going to do, because the data actually points somewhere a lot more useful and a lot more calm.
Why I still own it and what I own around it.
So if I don't trust the S&P to diversify me, why do I still own it? Because it's an incredible engine. It's cheap. It holds the best companies America has ever produced. The problem was never the S&P. The problem is owning only the S&P and calling that a finished portfolio. So let me show you the fix using a real example. Meet Priya. She's 29, lives in Austin, makes about $70,000 a year, and she invests $500 a month. For 3 years, every dollar went into one S&P 500 fund. She thought she was diversified. Here's what she actually owned. Around 35% of her money in 7 tech stocks, 0 exposure to the other 60% of the world's companies. One country, one bet. So Priya made one change. She kept the S&P as her core and she built around it. There are 2 clean ways to do this, and I want you to see both. The first is the simplest decision in investing. One fund called VT, the Vanguard Total World Stock ETF. One ticker that holds nearly the entire planet, over 10,000 companies across about 50 countries. Its expense ratio is 0.06%, which is basically nothing. Here's why VT is the direct answer to one bet, not 500. In the regular S&P, the top 10 companies are about 38% of your money. Inside VT, the top 10 are only about 21%. Same giants, half the concentration, and it automatically adjusts the mix between America and the rest of the world for you forever. You never touch it. The second way gives you more control. You hold 2 funds, VTI, which is the total US market, not just the Big 500, and that's a 0.03% fee. Then you add VHEX US, which is everything outside the US, at 0.05%. You decide the split. A lot of younger investors run something like 70 or 80% US and the rest international. Priya chose VT for one reason. She didn't want a second job. She wanted to set it once and get back to her life. Here's the myth that keeps people stuck. Diversifying just lowers my returns. Here's the truth. In the lost decade, diversifying didn't lower returns, it saved them. But before any of this matters, there's one number you have to look at, and it has nothing to do with which fund wins. That number is price, not the price of the fund, the price of the whole market. There's a famous measure called the Shiller PE. Don't overthink the name, it just tells you how expensive stocks are compared to their long-term earnings. The higher it goes, the more you're paying for every dollar of profit. The long-term normal for this number is around 16 or 17. Right now, in 2026, it's sitting above 40. That has only happened one other time in over 150 years of stock market history. That time was December 1999, right before the lost decade. I want to be careful here because honesty matters more than fear. A high price does not mean a crash is coming. It is not a countdown timer. Markets can stay expensive for years. And there are very smart people who think America keeps winning. Analysts at firms like Fidelity argue that US companies simply make more money than their foreign rivals industry for industry, and that buying cheap foreign stocks can be a trap. That's a real argument, and I'm not going to pretend it isn't. So here's the honest verdict. This isn't America bad, foreign good. History doesn't say international always wins. What history actually says is that leadership rotates. The US led for most of the 2010s. In 2025, international stocks beat the S&P by the widest margin since 1993. The crown changes heads. It always has. So the question was never which country will win the next 10 years. Nobody knows that. The real question is, are you okay being completely wrong if you bet on just one? Because here's what that decision is worth over time. If Priya keeps investing $500 a month and the market delivers something close to its long-run average, she's looking at well over $1 million in 30 years. The single biggest risk to that number isn't picking the wrong fund. It's having one bad decade land at the wrong time with all her money in one place. Diversification is the cheap insurance that keeps one bad decade from breaking the whole plan. So let's make this real. Here's exactly what to do this week. First, find out what you actually own. Open your portfolio and look at your largest holding. If it's an S&P 500 fund, you now know the truth. Around a third of it is 7 tech stocks. Second, pick your lane. If you want one decision and no maintenance, that's the total world approach in a single fund. If you want to control your own US and international split, that's the 2-fund approach. Neither is wrong. The wrong move is doing nothing. Third, do it inside the right account. If you have a 401k with a match, get the full match first. That's the closest thing to free money you'll ever find. After that, a Roth IRA lets your gains grow tax-free, and for 2026, you can put in up to $7,500. Then, automate it and walk away. Set a monthly transfer. Let compounding and time do the heavy lifting. That's the whole game. Diversification isn't betting on the winner, it's refusing to bet your whole decade on one. If you know someone who's 100% in the S&P 500 and thinks they're diversified, send them this video right now. It might be the most useful 5 minutes of their year. And tell me in the comments, after watching this, are you sticking with 100% S&P or are you adding the rest of the world? I genuinely want to know where you land. If you're building wealth and you actually want to understand what you're doing with your money instead of just guessing, subscribe to this channel. That's the whole point of this channel. Next time, I'm breaking down the exact 3-fund portfolio and how I'd split US stocks, international, and bonds at every age. I'll see you in that one.